The Dow bounces nearly 1,300 points. The Dow plunges nearly 1,000 points. An emergency rate cut from the Federal Reserve. And Robinhood breaks. Hey guys, I'm Tex. Thanks for joining me for Market This Week, where we'll discuss the headlines, review technical analysis, and check up on my investment portfolio with M1 Finance. If you're new here, I share my journey and experiences with trading and investing in the stock market. Thanks so much for tuning in, and if you enjoy the video, please consider hitting the like button for me and subscribe to the channel. Okay guys, what a wild week in the market. We saw a lot of ups and downs. There was a lot of whipsaw action in terms of trading as well, but definitely a lot of opportunities out there. Just to highlight some of the movements in stocks, Market Watch here posting on the March 2nd, saying the Dow bounces nearly 1,300 points. And that was obviously a huge reversal after the sell-off that we had seen from the previous week. And then on March 5, stock market plunges nearly 1,000 points. So we'll see the charts in a little bit when we go over the technicals, but a lot of really huge volatile range. And it doesn't seem like it's going to be going anywhere for a little while. Then you have the Fed coming in, cutting interest rates by 0.5 percentage point, calling it an emergency rate cut. And really, the market initially popped on that news that came out. If you were watching it live, it was a really huge rip to the upside when the algo started buying it up. But then it just faded for the rest of the day. And I think what ended up happening here is it really kind of spooked investors to see, hey, why is the Fed all of a sudden just stepping in and cutting interest rates in between meetings? This is not normal. And so that really spooked investors and made them believe that, maybe the Fed knows a little bit more and about the severity of everything that's going on with this illness. So that was a surprise, and that did lead to a big downturn in the market on that particular day. And then we have this posted on March 6th. U.S. oil plunges 10% and books biggest daily loss in more than 5 years as OPEC talks collapse. So basically, you have Russia, who is not agreeing to cut production in order to help out with the rapidly falling oil prices. Of course, you have declining demand with the illness going on, and you have a lot of oil essentially stockpiled. We have more oil than we need right now, so that is causing a rapid fall in oil prices, and that's obviously not helping things out either. So in last week's video, we talked about Fidelity and Vanguard that had a brief outage because of the increased volatility in the markets and the amount of clients that were trying to access the platform in order to sell or buy some of their positions when the market was really selling off. Well, Robinhood takes the cake. On the day the Dow rallied to one of its biggest gains in history, Robinhood was down for not 1 hour, not 2 hours, but all day long. Now, this posed a big problem for Robinhood users who perhaps were short when the market decided to have that huge rally, and they were unable to cover their positions, especially if they were in options. Not to mention Robinhood users who wanted to buy the dip couldn't even access their account in order to do that. Needless to say, I'm certainly glad that I moved away from Robinhood, but with any of these discount and new type of brokerages, there's no guarantees that they won't at some point have some type of technical problem like this. So it was certainly eye-opening to see how long one of these platforms could go down, and really another reason why you would want to diversify your funds the same way you diversify your investments. You don't want to put all of your money in one location. But that was relatively an interesting story to see how that played out, and I believe they continue to have problems going into the next day. There was rumors that it was the leap year that caused the problem, some coding error within Robinhood. However, basically they came out and said that it was due to the increased demand and the volatility in the markets and the amount of people trying to access the service that essentially caused the app to just break. On Friday, the U.S. job numbers came out, and they were actually good. They were a beat. However, there is some concern about this being a lagging indicator. That's because the slowing in the economy with the China illness could be causing businesses to cut back in the future if they start to slow down too much, which would mean cuts to jobs. And so the next job numbers might actually be a miss. So it raised kind of a little bit of concern for investors, but it did nevertheless beat. Finally, I just want to touch on this article that says that long-term stock investors still shouldn't buy the dip, but it's an opportunity-filled environment for pro traders. Now, obviously, I agree with the last statement. As traders, we love volatility, and there's plenty of that to go around right now in the market. However, I tend to disagree with that first statement. Now, obviously, I'm not a professional or a financial advisor or anything here, but if you've got a very long time horizon to invest in the market, it's more important that you just get into the market, because studies have shown that missing just a small percentage of the biggest days in the market can really reduce or severely diminish your returns in the long run. So if you've got a very long time horizon, in my opinion, you have more than enough time to ride out any future recession if that were to happen from these events going on right now. Or whenever it does come, you have more than enough time to ride out a future recession, and make sure that you're in the market for those big growth months and years that will lead you into retirement. So you've got the market right now that essentially is on sale. You could argue that it needs to come lower. Valuations are actually still a little high. Yeah, they're better than they were last month, but they could be argued that they are still a little high. Regardless, when you are given a dip in the market and you have something that's cheaper than it was, it doesn't matter what you're buying. Isn't that always something that you look for? That's a good deal. You want to take advantage of that deal. Now, again, everyone's situation is different. If you don't have as long to invest, then you have to approach it a little bit differently. But more specifically, speaking to people like myself who definitely have a long time horizon, at least 20 years or more, we don't necessarily have to worry as much about that. So I tend to think that, especially if you haven't even gotten started investing in the market, you might as well take advantage of a dip. Now, again, I'm not a financial advisor here, but this is just my thoughts and my opinion on it. So I think he just kind of generalized this in the article because everyone's situation is different. And for some people, it might actually be a good time to buy, and others, it might not. So I'm just curious what you guys think. I'm going to put a poll up at the top of this video you can click on and go and vote. Do you think this is a good time to buy the market, or would you hold off and maybe wait and see what develops with the events going on around the world right now? All right, guys, so let's take a look at the technical analysis here. We're going to start out with the S&P 500 futures. We are looking at a weekly chart. As we can see, the previous week we had, this was our big down move here. And then this week here, although we did close a green week, it's very concerning that we left this long topping tail right there. And we're going to look at exactly where we failed and how significant that is. Now, I have a fib drawn here, and you'll notice that this is drawn from the low in December of 2018. Again, this was that 20% correction that we had if you were watching the market during that time. The big rally throughout 2019 off of that low. So what I did is I drew a fib from that low to our all-time high, and you can see that where we stopped is exactly on that 50% mark. So essentially we retraced 50% of that rally off of that 20% correction. And again, you know, from a technical standpoint, we essentially bounced right here, which was the higher low that we put in before the significant breakout move from this relatively wide range that we had been in for about 2 years. So that was significant because we had been trading essentially sideways, although relatively in a wide range, until here. This was our breakout. So we gave all of that back, and essentially, like I said, we gave back half of everything that we gained from that last big correction. So that was significant. Now, what I'm going to do is I'm going to put a second fib on the chart, and let's go to our daily chart here. And for this fib, we're going to go from our all-time high. We'll just get it as close as we can to the low here of the sell-off. Now, we draw it from the high to the low because we are measuring a new trend. We are now in a downtrend. Whether this becomes a long-term downtrend or this is just a short-term downtrend, the dip gets bought, we don't know yet. Okay, so with this new fib on here, I modified it to show our 38.2, our 50%, and our 61.8 right there, there, and there. Now, this is your traditional fib levels that you want to pay attention to. When you are drawing it like this, we are measuring our new downtrend. We're basically measuring distances for any potential bounces to play out on that trend. And what we first look for is a 50% retracement. Okay, so we have this really big extended down move. We put in the low, we draw the fib, and we look for that 50% retracement, and we got it. We got it right here. And we also touched it right here on this day as well. But the fact that we weren't able to close above that 50% is very concerning. And we did an about face and came all the way back down. We did not come back down to the low, but we did come significantly lower off that 50%. Now, the real important level here for the case of the bulls to really take control again is the 61.8. We need to get above and close above that 61.8. If we can do that, then that really does put it in favor of the bulls to see the market make a rally back up to the all-time high. As long as we remain under that 61.8 or even worse, underneath that 50%, that is most definitely bearish, and that opens the door for us to potentially come lower. So what we'll do is go back to our weekly chart, and if we take a look at our fib that I drew from this low here in December to our all-time high, since we haven't yet broken the 50%, if we come back down and break that low, that definitely is going to open the door for us to at least visit the 61.8 on the downside here. Again, that's a very, very important number. So I would expect that breaking this low is definitely going to open the door for us to come down into that 61.8. And you can see that we do have some technical support that comes in right there as well. Now, if we break below that, that could really be bad for the market. And that could open the door up for us to come down possibly as low as this low here from that December 2018, that 20% correction right there. That would be significant in terms of percentage. Let's give that a measure and see exactly what that comes out to be. From all-time high down to there, you're looking at about a 31% drop. So that would be obviously clearly bear market territory, and that would definitely be a bad situation. What I'm going to do is go to our hourly chart for the NASDAQ futures. And again, I discussed these fib projections were from the previous month, but you can see how nicely these levels have actually been playing out. So again, we have kind of fair price area here, here, and here. Okay, so everything in between would be either overbought or oversold, right? So if you're moving up from the bottom, it would be overbought. And if you're moving down from the top, it would be oversold. All right, and what we did is we came into the bottom here of this fair price zone right about just above 8,100. And we bounced up into 8,900. That's a pretty significant bounce. A lot of volatility definitely present. We tried to hold within this fair price zone here, but we did break down below it, and we're really kind of teasing with the upper end here of the next fair price zone. Okay, so zooming in on this a little bit, I think that really if we can't hold up here, if we can't recover here and move back up and call this kind of like a higher low, that would open up the bearish scenario for that market to really come down lower. Now on the NASDAQ, for it to come lower, again, I do like when we look at the monthly chart here, if we break down and we can't hold the lows that we sold off on here from that previous week, I do like the NASDAQ to make a run down to that 20 moving average here on the monthly chart. That's a real possibility. From a technical standpoint, go back to our weekly chart. The NASDAQ hasn't yet tested its breakout zone right there. It's very close, but it technically has not tested its breakout zone from that previous all-time high. To get down to that 20 MA on the monthly chart would require us to come a bit lower. So I think that the next technical level is going to probably come in right about here, call it right around that 7,400 area. So again, breaking the lows for the NASDAQ definitely opens the door for it to come down a little bit lower, possibly into that 20 moving average on the monthly chart. So the Russell is trying desperately to hold the bottom of this channel that's been going on really since we recovered after the December 2018 sell-off. We've been trading within the channel for quite a while. Here was our attempted breakout and huge failure here when the market corrected. But when we look at this, it's struggling. It is underneath the channel, so that would be considered bearish. If we start to see the breakdown on those technical levels on the S&P and the NASDAQ, that'll definitely open the door for the Russell to make a run down here to that December 2018 low. We'll see if for some reason things do start to improve and the S&P and the NASDAQ rally that would open the door for the Russell to move back up through this channel. As of right now, based on what I'm seeing in the fundamentals and the technicals, I'm more inclined to think that we're going to come lower in the market broadly. The S&P, the Dow, the NASDAQ, the Russell should all make moves lower based on what I'm seeing right now. So that's kind of what I'd look for to the downside, certainly on the market and for the Russell here. And finally, we're just going to look at the VIX here. Looking at the weekly charts, obviously volatility remains incredibly elevated. We're seeing that in our options trading as well. Options contracts are quite a bit more expensive than normal because of that. But our elevated levels of the VIX here is at levels that we haven't really seen since early 2018. That was that correction in February of 2018. And we did spike just above that right there. So, it's remaining elevated and most likely it's not going to change for the foreseeable future, at least for a couple more weeks, possibly longer than that. So volatility is here to stay and something that we certainly need to get used to. And that means sizing down in your trading. Definitely need to do that in a high volatility environment and manage your risk appropriately. And that's, really the biggest thing you can do is adjust your sizing, especially when you're trading options. We have to remember that those options premiums are going to be a lot more expensive when volatility spikes up like this. So you're inherently taking on more risk the more expensive those contracts are. So very carefully consider your sizing in these trades. So we'll wrap up by looking at my dividend growth portfolio here with M1 Finance. If you're not familiar, this is a account that I created to essentially put any extra money I save into this and allow it to grow in the stock market. The strategy is to invest in high quality dividend paying companies to essentially reach passive income. We want our money to be working for us because sitting in a savings account is not going to make as much of anything. So obviously I am red on the account right now because I started investing just as the market was going into this correction. Now some people might ask, well, why are you buying if the market might go lower? Well, we don't know for sure what the market's going to do. And I'm a long time horizon investor, so it's more important that I just get into the market. We could have some big rally in the market in the coming months. And if you waited to invest, you could miss out on that rally. And there's really no point in doing that if you have a long time horizon, in my opinion. So regardless if the market pulls back lower or worst case scenario, we do go into a recession because of the events going on in the world right now, I will continue to invest the same as I normally would. If we go into a recession, I will be investing and adding all the way down, essentially cost averaging in, bringing my average down the more and more that we continue to sell off. When the market recovers years down the road, my portfolio will recover along with it. And again, remember that I'm going to continue to get dividends throughout that whole time unless one of my companies cuts their dividends. And that would be one of the main reasons why I would sell a company. If the company that I invest in does not cut their dividends and they at least hold it the same or better yet grow their dividends, then there is no reason for me to sell the company unless something drastically changes fundamentally with the company. But with that said, essentially I am invested in 23 companies. I have them split up between different sectors. We can see that I am green currently in healthcare, communications, and utilities. The rest are obviously all red. The big loser is definitely without a doubt the industrials. And inside of there, we have Boeing, which I'm just getting crushed on, down 18.75% on that one. Now this is money weighted returns, but nevertheless, definitely getting crushed on Boeing. And I did add Delta Airlines to my portfolio this week. I realized that airlines could come lower still with the events going on in the world right now, but it's a company that's been on my watch list of something I was thinking about buying. And with this big pullback in the airlines right now, it's really brought them down to very appealing valuations. And Delta Airlines was one that I really liked from a fundamental standpoint. And to top it off, Warren Buffett also added to his investment into Delta Airlines. So that was also a plus that really just kind of made me realize I should go ahead and buy it now. Even though it might come lower, I can always cost average in the same as I would with any other company within my portfolio. So when we look at this, we can see the overall performance of this sector. We can see how much I actually have invested in the sector, what it's actually worth, the dollar gain or loss, and the return right there. When we go to the entire portfolio, I am actually sitting at $11,977 in value. From that, I've contributed $12,500. Then you take away the market losses to date of $522.44, and that gets us where we are currently on our value. We look at the gains here. We will notice that it's a little bit different because I have earned some dividends. So obviously it's very early. It's going to take some time for the dividends to start pouring in, but we are sitting at $7.92 in earned dividends. And so our total loss to date, $514.52. Now our return here is down 5.85%. And again, I would mention this is a money weighted return. So basically that's going to make it look worse or better than it really is. If we want to see our true return, we can go to our holdings page, and I'm going to sort by cost basis. So the companies that I have the most money invested in are here at the top, and the least are at the bottom. Here we are with Delta Airlines, my newest investment, right here at the bottom. And on our very bottom of the screen, we can see our true return here. So I'm actually down $522.54 in terms of dollars, and that equates to down 4.18% on the entire portfolio. So overall, this is the companies that you can see I'm invested in. There are several companies that I am green on, and there's some that I'm getting close to being green on as I've cost averaged in. Again, the biggest loser without a doubt is going to be Boeing. So if we look at that in terms of true returns, there you are, down 14.17%. Now in terms of dollar, it's not really that big of a deal. It's $90.50. But it's certainly a big deal when we look at that percentage gain. So the negative headlines just continue to come out with Boeing, but overall, this is a company I believe in the long run. So I'm not overly concerned about it. Again, the more Boeing sells off, the more I'm just going to keep averaging down. Essentially, if I believe in the company, there's no reason for me to not continue to invest in the company. So that's my portfolio, as you can see here from N1 Finance. I just would finally wrap up by showing you this spreadsheet that I created. And this is actually really convenient to track all of your investments on one page. I like to do this just to kind of have my own data collected here as a little bit of redundancy. But basically, I made it as simple as possible. I have to populate everything within these fields here, and then the rest of the spreadsheet auto calculates the information. One of the most important things we can see from this spreadsheet is that my annual dividends are $452.12 to date. So essentially, my money is making me $452 a year by just having it invested in these companies. So that's really a nice thing. Obviously, as the portfolio grows, your annual income grows, and it really becomes exponential from there. You have compounding interest working for you, your dividends get reinvested, and you just get exponential growth going forward. So we look at how we have everything broken up. Over on the left side here, I have my companies that I'm invested in and their market values on the bottom. And then we just kind of look here at how I have the sectors weighted out. And this is actually looking at how the sectors currently weigh. So this will fluctuate depending on market movements in each of these stocks, but trying to go relatively equal on the sectors. But I did want to go a little bit overweight in real estate because they pay higher dividends. But for the most part, I'm going for the relatively equal weighting in the sectors. So that's going to do it today, guys. I really appreciate you watching the video, sticking around to the end. I have some other interesting content on my channel if you want to look at some live trading. I talk about trading options in the market, and I also have some other investment type videos if you're more interested in that type of content. If you would, do me a favor, hit that like button if you enjoyed the video. I really appreciate that. Consider subscribing to the channel for more content like this in the future. And always love to hear from you guys. If you have any comments or questions, feel free to answer those below, and I'll make sure that I get to each and every one of you. So with that said, guys, hope you have a great weekend. Take care, and we will catch you in the next video. See ya.